You've got some money sitting in your savings account. Not a life-changing amount, but enough that it feels wasteful, honestly, to just leave it there, earning whatever pathetic interest rate your bank pretends is generous. Maybe it's $5,000. Maybe it's $15,000. Maybe you've been really disciplined and you've got $30,000 just sitting there, and every time you look at it, you think, I should be doing something with this. So you start Googling. You watch a few YouTube videos. You see people talking about index funds and ETFs and individual stocks and crypto and real estate and all these different ways to invest. And everyone sounds so confident, so certain that their way is the right way. But the more you research, the more confused you get. Because for every person saying, just buy the S&P 500 and forget about it, there's someone else saying, that's outdated advice. Here's what you should really do. For every person preaching index funds, there's someone showing off their gains from picking individual stocks or timing the market or whatever. And you're stuck in this weird paralysis where you know you need to invest, you know you're losing money to inflation every day you wait, but you're genuinely not sure what the right move is. And honestly, the fear of making a stupid decision and losing money feels worse than the slow erosion of doing nothing. My name is Jack, and I spend way too much time thinking about investing, market psychology, and specifically why so many smart people make terrible investment decisions even though they have access to all the information they could possibly need. And what I've realized after years of studying this, after watching friends and family make both brilliant and disastrous investment choices, after making plenty of mistakes myself, is that the biggest problem isn't a lack of information. The problem is too much information, most of it terrible, combined with psychological traps that our brains are basically hardwired to fall into. But here's what's interesting. If you understand just a few key principles, not complicated strategies, not advanced techniques, just fundamental truths about how investing actually works, you can avoid probably 95% of the mistakes that cost people enormous amounts of money. You can build wealth steadily and boringly and successfully without needing to be a finance genius or spending hours researching stocks or timing the market or any of that exhausting nonsense. So, if you're sitting there in 2026 with money to invest and you're not sure where to start, or if you've already started investing but you're second-guessing everything you're doing, this is for you. Because what I'm going to talk about isn't flashy or exciting or going to make you rich overnight. But it's the stuff that actually matters. The stuff that separates people who build wealth over decades from people who chase returns for years and end up with nothing to show for. The game has changed, but not how you think. Let's start with something important. You're investing in a different environment than people were 10 or 20 years ago. And I'm not talking about AI stocks or crypto or whatever the hot thing is right now. I'm talking about the structural realities of markets in 2026. Interest rates have been on a wild ride. We went from near zero rates for years to rapid increases to wherever we are now, depending on what the Fed has decided recently. Bond yields aren't what they used to be. Stock valuations are complicated. The economy is doing that thing where different indicators point in different directions, and nobody can quite agree if we're heading for a recession or continued growth or something in between. And here's where people get stuck. They think they need to figure all this out before they invest. They think they need to understand the macroeconomic picture, predict where interest rates are going, time their entry into the market perfectly. They watch the news and try to decode what it means for their investments. But here's the truth, and this is probably going to sound overly simple. None of that matters for most people. I know someone who spent all of 2022 researching the perfect time to invest. He was convinced rates were going to keep rising, that stocks were overvalued, that a crash was coming. So he kept his money in cash, waiting for the right moment. And you know what? He was partially right. The market did have a rough 2022, but then 2023 came and the market rallied significantly, and he still hadn't invested because he was waiting for the crash everyone kept predicting. By the time he finally invested in late 2024, he'd missed enormous gains and lost 2 years of compound growth. His attempt to be smart and strategic actually cost him tens of thousands of dollars in potential returns. This is the first trap I want to warn you about, trying to time the market. Because here's what the data shows. Year after year, decade after decade, time in the market beats timing the market, almost always. Almost everyone who tries to time their investments perfectly ends up worse off than if they just invested consistently, regardless of market conditions. And I get it. It feels smart to wait for a dip. It feels responsible to be cautious when valuations seem high. It feels like you're being strategic by holding cash until conditions are perfect. But perfect conditions never come. There's always something to worry about. There's always a reason to wait. In 2019, people were worried about political uncertainty. In 2020, there was a pandemic. In 2021, people worried about inflation. In 2022, rising interest rates. In 2023, banking crises. In 2024, election uncertainty. And here we are in 2026, and I guarantee you there are at least 5 things that financial media is telling you to worry about. But if you look at a chart of the market over any significant time period, 20 years, 30 years, 40 years, you see that it trends upward despite all those concerns. The people who stayed invested through all the scary news did fine. The people who kept waiting for the perfect moment to invest generally did not. So the game hasn't changed in the way that matters most. Long-term, diversified investing still works. What has changed is that we're now drowning in information and opinions and predictions, most of which are designed to make you feel like you need to do something active and clever when the best strategy is usually to do something simple and boring. You're probably thinking about risk wrong. Let's talk about risk, because I think most people have a completely backwards understanding of what risk actually means when it comes to investing. Ask someone what feels risky, and they'll probably say something like, investing in stocks, especially right now when markets seem uncertain, when there's news about inflation or recession or whatever. Keeping money in a savings account, earning 3% or 4% feels safe. It's FDIC insured. It's guaranteed. You can't lose it. But here's the problem with that thinking. Inflation. Let's say you have $20,000 in a savings account earning 4% interest. After a year, you have $20,800. Cool, you made $800. Except if inflation is running at 3%, the purchasing power of your $20,800 is actually only worth about $20,176 in today's dollars. So your safe investment actually only netted you $176 in real returns. That's a 0.88% real return. Now, is that better than losing money? Sure, but is it building wealth? Not really. You're barely keeping pace with inflation. And if inflation ticks up to 4% or higher, you're actually losing purchasing power even though your account balance is going up. This is the risk that most people completely overlook. The risk of not investing, the risk of being too conservative, the risk of letting inflation slowly erode your wealth. It's not dramatic. You don't wake up one day and discover you've lost 30% like you might in a stock market crash. But over 10 years, 20 years, 30 years, it's devastating. I know someone who kept $100,000 in cash and conservative savings accounts from 2010 to 2020 because they were afraid of the stock market after the 2008 crash. They wanted to be safe. Meanwhile, the S&P 500 more than tripled during that decade. They didn't lose their $100,000, sure, but they missed out on $200,000 or more in potential gains. That's the cost of being too safe. And here's the thing about stock market risk that's counterintuitive. It decreases over time. In any given year, the stock market might be up 30% or down 20%. That's genuinely volatile and risky if you need the money soon. But over any rolling 20-year period in history, the stock market has never had a negative return. The longer your time horizon, the more the volatility smooths out and the more certain the positive returns become. So if you're in your 20s or 30s or even 40s and you're investing for retirement, the risky investment is actually the safest one in terms of protecting and growing your purchasing power over time. The safe investment, keeping everything in cash and conservative savings, is actually the riskier choice because you're almost guaranteed to lose to inflation over decades. This is a mental shift that's really hard to make because it goes against our intuition. Volatility feels like risk, but risk isn't just about short-term fluctuations. Risk is about the probability of not achieving your financial goals. And if your goal is to build wealth for retirement over the next 30 years, keeping everything in cash is pretty much guaranteed to fail at that goal. Now, I'm not saying you should put every dollar into stocks and ignore all other considerations. There's nuance here. If you need the money in 2 years for a house down payment, yeah, stocks are too risky. If you don't have an emergency fund, you need cash accessible. If you're retired and living off your savings, you need a different allocation. But for most people watching this, people with decades until retirement, people trying to build long-term wealth, the risk they should be worried about isn't market volatility. It's the risk of being too conservative, too scared, too safe to actually grow their wealth at a pace that beats inflation meaningfully. The complexity trap. Here's something I see constantly. People who are ready to invest, who understand they need to invest, but they convince themselves they need to learn so much more before they can actually do it. They think they need to understand financial statements or be able to evaluate PE ratios or have strong opinions on which sectors are poised for growth. And so they spend months, sometimes years, researching and learning and trying to become this sophisticated investor who can pick winning stocks or time the market or whatever. And in the meantime, their money sits in cash, earning nothing while they're stuck in education mode. This is what I call the complexity trap, and it's particularly insidious because it makes you feel productive. You're learning, you're being responsible, you're not rushing into anything stupid, but the result is the same as if you'd done nothing at all. Your money isn't growing. Here's a truth that the financial industry doesn't really want you to know. For most people, investing should be incredibly simple, like genuinely simple. Not once you understand these 17 concepts, it becomes simple. Just actually simple from day one. The basic, boring strategy that works for the vast majority of people is this. Invest in a low-cost, diversified index fund that tracks the total stock market or the S&P 500. Contribute to it consistently regardless of market conditions. Don't sell when the market drops and let it compound for decades. That's it. That's the entire strategy. You don't need to pick stocks. You don't need to time the market. You don't need to understand complex financial concepts. You don't need to read earnings reports or follow the news obsessively or have any particular insight into where the economy is headed. I know this sounds too simple to be effective. We're conditioned to think that building wealth requires sophisticated knowledge and complex strategies. But the data is pretty clear. The vast majority of professional fund managers, people with MBAs, teams of analysts, sophisticated models, all the resources in the world can't consistently beat a simple index fund over long periods. If the professionals can't do it, why do you think you need to? Why do you think you need to be smarter or more sophisticated than you actually need to be? I wasted probably 2 years early in my investing journey trying to be clever. I researched individual stocks. I tried to identify undervalued companies. I thought I could find opportunities that the market was missing. And you know what happened? I underperformed the S&P 500. My carefully researched portfolio of individual stocks did worse than if I just bought a boring index fund and ignored it. And I'm not alone in this. Study after study shows that individual investors who actively trade, who try to pick winners, who try to be sophisticated, they generally do worse than passive investors who just buy index funds and hold them. The complexity trap makes you feel smart while making you poorer. The simple strategy makes you feel unsophisticated while making you wealthier. Once I finally accepted this, once I swallowed my ego and admitted that I didn't need to be a genius stock picker, my investing got so much easier and so much more effective. Now, I know some of you are thinking, but Jack, what about those people who make millions picking the right stocks or investing in the next big thing? And yeah, those people exist. But for every person who picked Amazon at the right time, there are thousands who picked companies that failed, who timed the market wrong, who underperform basic index funds. You only hear about the winners because they're the ones making YouTube videos and writing books and giving interviews. You don't hear about the countless people who tried to be sophisticated investors and ended up with mediocre or terrible returns. Survivorship bias makes it look like active investing is more successful than it actually is for most people. So here's my advice if you're caught in the complexity trap. Give yourself permission to be boring. Give yourself permission to use the simplest possible strategy. You don't need to be sophisticated, you just need to be consistent. Number, the asset allocation question everyone overthinks. Okay, so let's say you've accepted that you're going to invest in index funds. Now the question becomes, which ones? And in what proportions? And this is where people get stuck again, because suddenly you're reading about domestic stocks versus international stocks, large cap versus small cap, value versus growth, bonds versus stocks, real estate, commodities, all these different asset classes. And the natural instinct is to think you need to have some perfectly optimized allocation across all these categories. You see people posting their detailed portfolios: 40% domestic stocks, 20% international, 30% bonds, 10% real estate, rebounds quarterly, according to some sophisticated formula. And look, there's nothing wrong with that if it makes you happy. But here's the thing. The difference between a pretty good asset allocation and a perfectly optimized asset allocation is probably 0.5% of returns per year. Maybe. Over 30 years, that might add up to something noticeable, sure, but it's not the difference between retiring comfortably and being broke. The difference between investing and not investing, that's life-changing. The difference between investing consistently for 30 years versus stopping and starting or trying to time the market, that's life-changing. The difference between paying 0.05% expense ratios versus 1% expense ratios, that's life-changing. The difference between having 70% stocks and 30% bonds versus 80% stocks and 20% bonds, probably not life-changing. I'm not saying asset allocation doesn't matter at all, but people spend so much energy optimizing their allocation when they should be spending that energy on just investing more money more consistently. Here's a reasonable approach that will serve most people well. If you're young with a long time horizon, maybe 30 or more years until retirement, you can be aggressive. Subscribe. Guys, we upload daily investment videos,